Hello and welcome to the Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance, from financial planning tips to how what's going on in the world around you affects your money, in your wallet, and most importantly, your financial future.
If this podcast helps you, please like and subscribe so that we can help as many people as possible moving forward. On this episode, we're going to be talking about pensions and what happens to your pension when you pass away. This is the most commonly asked question by our clients when advising on pensions. To answer this question, it all depends on the type of pension you have and if you've completed the correct paperwork. Today, Ashley is going to explain to us what happens on death to some of the most commonly asked pension types available in the UK. If you could, Ashley, can you explain first of all what happens to a defined benefit pension on a person's death?
Of course. So firstly, I just want to give a very brief explanation of what a defined benefit pension is. So a defined benefit pension effectively commits to providing you with a guaranteed income once you get to your set retirement age. This income, to some degree, is usually linked to inflation as well. Some of the most common schemes are those for employees of the NHS, teachers, civil servants, but they do exist in the private sector as well, although these are becoming less common. When it comes to death benefits, unfortunately there's no single or simple answer on this one. The scheme rules usually will set out what's going to be payable on death and to who and in what format. And these will differ from scheme to scheme, and they may also depend upon whether you die pre-retirement or post-retirement as well. Can also depend on whether or not you're still an active member of that scheme or whether you've left that employer and that pension is sort of set aside for you for when you do get to retirement. A big thing with it as well is there's usually very little flexibility on the death benefits as well. The scheme will set those rules out, and once those rules are in place, they tend not to change.
Okay, so how about a defined contribution pension? What happens to these pensions on the death of a policyholder?
Okay, yeah, so again, it's worth clarifying just very quickly what a defined contribution pension is before going on to explain the death benefits. So a defined contribution pension, which is sometimes known as a money purchase pension, you effectively build up a pot of money that you can then use when you get to retirement to provide lump sums or an income. Unlike the defined benefit scheme, which, as we said, promises an income in retirement, this provides you, as I say, with a pot of money to then work out how you're going to pay that income. The fund that you'll have at retirement will be very much dependent upon a number of factors. It's not just dependent upon how long you've worked for that company, but actually it's dependent upon how much you've paid in, how much your employer's paid in, what the investment performance has been. And the death benefits for these types of pensions are usually best explained by looking at both sort of pre and post-retirement, and also to do with age, pre and post age 75. So first of all, if you were to pass away before retirement, or more specifically before actually accessing your pension benefits, any money held within that defined contribution pension will not be distributed in accordance with your will. It's actually distributed in accordance with your wishes, and you give your wishes to the pension trustees, which is usually the pension provider, to tell them what should happen to your pension on your death. Now, if you're under the age of 75, effectively the entire pot will be paid out completely tax-free to whoever you have put on that death benefit nomination. If they're named on that nomination, they don't have to take the money out of a pension. They can keep that money in the nice tax-efficient environment of a pension, and when they do decide to draw any money from it, whether it's lump sums, whether it's income, that will be paid to them tax-free as well. If, however, you pass away after 75, the same thing happens in that the pot will still go to whoever you've nominated. However, any income or any lump sums that those individuals take from the pension will be added to their income and will be taxed as though it's just their income, so taxed at their marginal rate. So as you can see, it's very different to the defined benefit, and it's really important that you do review that expression of wish, because that ultimately tells the pension provider who to give that money to. It's also very important that that is done correctly, so that anyone you do want to receive that pension pot has all of the options available and can make sure any income they do draw is done in the most tax efficient way.
That's a really good point there. even if you've completed the expression of wish in the past, you should take the time to review this on a periodic basis just to make sure it's still in keeping with your current wishes as of today, because obviously life moves so quickly. You've explained that what happens to a pension on death before taking the pension benefits. Can you now explain to our listeners the difference if a client has already taken their pension benefit?
Yeah, so once you start to receive an income from your pensions, the death benefits will actually be dependent upon the options that you've selected when it comes to physically taking that income. If you're using a drawdown pension, which is where your funds remain invested and you simply draw an amount, it doesn't have to be a regular amount, it could be a lump sum, could be a regular income, where you draw that from the pension from the invested funds, the same rules apply. So if you die before 75, the pension's paid out or paid across tax-free to whoever you've nominated, and any income that they take is also tax-free. And if you pass away after 75, the same applies again as in the previous examples, whereby yes, your beneficiaries will still get the pot, but any income or lump sums they take would be taxed at their marginal rate. If, however, when you've set your pension income up, you utilise an annuity, which is effectively where you exchange your pension for a guaranteed income for life, the death benefits will be set up at the start of when you put that contract in place. Some of the most common death benefits, or some of the most common features people like to build into those, spouses benefits. So you can ensure that if you passed away, your pension will continue to pay to your spouse, usually at a rate of 50% or even 100% of the income that you were receiving. You can also build in guarantee periods, which ensure that your pension will be paid for a minimum number of years, regardless of whether you pass away. So a quick example there is if you set a 30-year guarantee period, but you pass away after 10 years, for the next 20 years, that pension will still be payable to your beneficiaries. Very important that when you do set those up, they're right for you, because once they are set up, there is usually no way to go back and change them. They're set in stone from the outset.
No, that's brilliant. I think a couple of really important things to take away here for our listeners is, firstly, it's so important that you review your pensions on a regular basis, not only to ensure that they are meeting your objectives now, but also they will fulfill your future wishes should you pass away. Secondly, when you do reach retirement, it is again really important that you ensure any options you utilise provided your income should not only give consideration to what you need immediately, but also longer term. Do you need to make any provisions for dependents such as children should you pass away first? It's so important. This is even more important if exchanging your pension fund for a guaranteed income, as once the contracts have been established, either with or without spouse's benefit or guaranteed period, you usually can't change this at a later date.
Exactly, yeah. So as part of the service at Wright, for any new or even our existing clients, when we review their pensions, death benefits is a huge part of that. We like to make sure that our clients understand what will happen with their pensions when they die, and allow them to take appropriate actions to update beneficiaries or instructions for when they pass away on a regular basis. And it may well be that things haven't changed, but we'd rather check that with them rather than just leave it with an outdated expression of wish. Obviously, as always, if you'd like to review your pensions with myself or one of the chartered financial planners here at Wright, you can contact us. The easiest ways to do that. Hello and welcome to the Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance, from financial planning tips to how what's going on in the world around you affects your money, in your wallet, and most importantly, your financial future.
If this podcast helps you, please like and subscribe so that we can help as many people as possible moving forward. On this episode, we're going to be talking about pensions and what happens to your pension when you pass away. This is the most commonly asked question by our clients when advising on pensions. To answer this question, it all depends on the type of pension you have and if you've completed the correct paperwork. Today, Ashley is going to explain to us what happens on death to some of the most commonly asked pension types.
This recording contains information from sources believed to be reliable, but no guarantee, warranty or representation express or implied is given to its accuracy. Wright does not undertake any obligation to update or revise any future statements. Past performance is not a reliable indicator of future results. Investments can go down as well as up, and actual results could differ materially from those anticipated. This recording is for the information purposes only and has no regard to the specific investment objectives or financial situation of any individual. The information contained in this recording is not intended to constitute and should not be construed as investment or financial advice. Appropriate personalised advice should always be taken before entering into any transactions. No responsibility can be accepted for any loss arising from action taken or refrain from being taken based on this publication. Howard Wright is authorised and regulated by the Financial Conduct Authority.